Hello, everyone. If I could ask you to take your seats. We are privileged to have someone important, so we want to be prompt. Good afternoon, and hello to our global audience online. Welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it's my personal honor and the Institute's privilege to host a speech today and a discussion on the recent changes in the Bank of Japan's monetary policy framework by Professor Kazuo Ueda, the governor of the Bank of Japan. I've had the privilege of knowing Kazuo, Professor Ueda, going back to when he was merely a leading academic. He has been appointed governor of the Bank of Japan a little over a year ago, at the start of April 2023. He, I believe, studied at MIT in his day, where some of our mutual friends were. He started his career as assistant professor at the Department of Economics at the University of British Columbia. He then became an associate professor at Osaka University. In 1993, he became a full professor at the University of Tokyo, specializing in macroeconomics and financial theory. He has previous public service in a number of advisory roles, but importantly, from 1998 to 2005, he was a member of the Bank of Japan's Policy Board, the central bank's highest decision-making body, where he led discussions on the introduction of forward guidance under the bank's zero interest rate policy. After completing his long and distinguished term as a member of the Policy Board of the bank, he became a professor of the Graduate School of Economics at the University of Tokyo in 2005, including serving as dean there for 2 years. Japan does have something of a forced retirement policy, and in 2017, he was awarded the title of emeritus. He's also served as an external member of the board of directors of the Development Bank of Japan from 2008 until he became governor in 2023, and chaired the investment committee of the Japan's Government Pension Investment Fund from 2010 to 2014. In recognition of his distinguished academic career from 2011 to 12, he was the president of the Japanese Economic Association. Now, the fact is, Japan has been one of the most interesting places to think about macroeconomic and monetary policy issues for a long time. It is also increasingly in today's world more and more important as not a warning example, but sometimes a role model for other countries dealing with debt and aging societies in a geopolitically fragmented world. This is a theme we hope to explore more fully at the Peterson Institute in coming months. But we today have the privilege, as I mentioned, to hear Governor Ueda talk about the recent changes in the Bank of Japan's monetary policy framework. Governor.
Thank you, Adam, for a very nice introduction. And I'd like to thank everyone coming or staying until this hour. It's 5 p.m. Friday. So I guess everyone wants to forget about the hard work he or she did during the last 5 days and be ready for the weekend. Now, my talk is about the hard or difficult, complicated monetary policy framework we had and how and why we terminated it. So I hope it fits the occasion or timing of the event. Needless to say, we, the BOJ, in terms of policy, are not going to go to a weekend or a vacation. We'll actually have moved back to, let's say, a more normal policy setting, whereby we set the short-term interest rate in response to incoming data and information in order to hit the 2% inflation target. So I'm beginning my speech. In the monetary policy meeting, March meeting, taking into consideration the improving inflation outlook, the Bank of Japan opted to discontinue the policy framework known as quantitative and qualitative easing with yield curve control, YCC, which had been in effect since 2013. First, I would like to give a brief outline of the changes made, and then talk about the background behind these adjustments. Now, regarding interest rates under YCC, we control both short and long-term interest rates. The short-term policy rate, the interest rate the BOJ paid on the so-called policy component of excess reserves stood at minus 0.1% as of early March this year. Meanwhile, the target for the 10-year JGB was set at around 0% with a permitted fluctuation range around the target capped at 1.0%. On March 19th, we decided to establish a new short-term interest rate target, now defined as the uncollateralized overnight call rate, set between 0 and 0.1%. The target for the 10-year JGB rate has been removed. As for asset purchases, we will maintain our acquisition of JGBs at a pace similar to before, thereby keeping the amount of JGBs held by the BOJ relatively stable for the time being. However, we remain prepared to respond swiftly to any rapid increase in long-term interest rates by increasing the amount of JGB purchases. Other than these, long-term interest rates are now determined by the market. We have stopped buying equity-linked ETFs and J-REITs, also gradually reducing purchases of commercial papers and corporate bonds to zero within approximately 1 year. We will begin to reduce JGB purchases at an unspecified point in the future. However, the extent of this reduction remains undetermined. We will need to take time to consider what to do with the ETFs we have at the moment. Given these changes, the primary tool of our monetary policy has become the control of the short-term interest rate, with the policy target continuing to be the attainment of 2% inflation in a sustainable manner. Based on our current economic and inflation outlook, we anticipate accommodative financial conditions to prevail for the time being. Turning to the background for this policy change, let me discuss how the inflation outlook has improved. Our previous monetary policy framework involved the commitment to maintain YCC until a sustainable 2% inflation target was within reach. In other words, we promised to persist with YCC until we were sufficiently confident that inflation would soon reach 2% on a sustained basis. Figure 1 provides a simple illustration of Japan's inflation dynamics. Recent inflation, which has exceeded 2% for nearly 2 years, consists of 2 main components: the direct or first round effects of global inflation during 2021 to 23, and second round effects, which represent the spillover of the first component to wages and subsequently to prices. The latter component has been accompanied by rising inflation expectations. The first component, deemed transitory, has been diminishing since late last year. The second component, often referred to as underlying inflation, is more enduring. This broader inflation picture mirrors that of many other countries. A notable distinction between Japan and others lies in Japan entering the pandemic era with nearly zero inflation, while others were already at around 2%. Consequently, the BOJ has endeavored to cultivate the second component by maintaining an ultra-easy monetary policy, contrasting with the efforts of other central banks to contain it. Estimating underlying inflation accurately is particularly challenging because of the varied forms temporary inflation changes can assume. These changes may manifest as alterations in energy and fresh food prices, or may extend to impacts on transportation costs and dining out expenses. Figure 2 shows some easily available inflation variables that have some bearing on underlying inflation. One is the inflation of those items whose prices do not change frequently. Another is the moving average of the inflation of general service prices. Both have been rising recently, but need to rise slightly more to get to 2%. We use more sophisticated statistical techniques to estimate underlying inflation in a variety of ways, but we obtain more or less similar results. The figure also includes the rate of change in regular wages of full-time workers. The broad picture is the same. Please note that the wages need to rise faster than 2% to be consistent with prices rising at 2% in the presence of positive productivity gains. Medium to long-term inflation expectations closely track underlying inflation trends. Figure 3 shows the weighted average of such expectations, indicating a rising trend, but remaining slightly below 2%. Now, let me try to add some color to this outline sketch. People often ask why inflation in Japan got stuck at around zero, despite the heavy dose of unconventional monetary policy measures over the last 3 decades. One possible answer is that inflation expectations became so entrenched at around zero that economic agents changed their behavior to make zero inflation more enduring. Theoretically, easy money could have produced higher inflation. In reality, it did not. This may be a multiple equilibrium type situation where easy money is consistent with either zero or higher inflation. The driver of equilibrium multiplicity seems to have been the strategic pricing behavior of firms in the economy. When firms believe their peers will not raise prices, they think it is best to keep their own prices and wages unchanged, even in the face of small changes in costs or demand, making overall inflation or inflation expectations more entrenched at around zero. An economy in such a situation needs a large shock to move from one equilibrium to the other, or to another. Figure 4 shows Japanese firms' expectations of the price level of their product or service, not the general price level, at both 1 and 5 year horizons, sourced from our Tankan survey. These presumably reflect firms' expectations about what their competitors in the same industry are likely to do with their prices. While 1 year expectations peaked in late 2023 before declining, 5 year expectations have continued to rise. Apparently, the global inflation experienced during 2021 to 23 has created a lasting change in firms' pricing behavior, perhaps providing a catalyst for movement from the zero to a positive inflation equilibrium. Returning to the explanation of the recent BOJ policy change, alongside these observations on underlying inflation and inflation expectations, robust initial wage settlements from this year's spring wage negotiations have emerged since mid-March. Figure 5 shows these settlement results to be at their highest level in 3 decades. While evidence of a moderate upward trend in domestic demand for goods and services has further bolstered our confidence. Based on these factors, we concluded in the March monetary policy meeting that the probability of achieving a stable 2% inflation rate has increased enough to justify the outlined policy normalization. What lies ahead? Given that underlying inflation is still somewhat below 2%, we need an easy financial environment. Figures 2 to 4 suggest that long-term inflation expectations are above 1%, perhaps closer to 1.5%. Estimates of the neutral rate vary widely. However, unless the real neutral rate is deeply negative, the nominal policy rate of 0.1% implies a fairly accommodative financial environment. We will proceed cautiously, initially assessing the impact of the recent policy changes on the economy and inflation, and then considering further adjustments as deemed appropriate, perhaps extracting insights on the neutral rate along the way. Let me stop here.
Thank you, Governor Ueda, for your remarks and for your willingness to discuss further and a little deeper in questions. Let me pick up on some of the most striking things you said. You spoke about a large shock potentially having moved people's expectations, business wage inflation expectations, from one equilibrium to another. And you had, I guess it was figure 5, that very striking chart of blue bars showing how high the current round of wage settlements this year were. Could you say a bit more about what you will be watching for going forward in terms of inflation expectations continuing to rise or being anchored at a certain level? Do you worry at all that the virtuous circle at some point becomes a less virtuous spiral between prices and wages? How do you think about those long-term expectations issues?
So, of course, we will be watching what will happen to inflation expectations. But as far as hard data are concerned, we will first watch what will happen to wages. This data in figure 5 is results from wage negotiations, especially among more or less large firms. So we would like to know what will happen in the economy as a whole to wages. And then, of course, we would like to see what the effect of those possible wage increases be on prices, especially service prices, and check whether we would like to check whether this wage price spiral, we call it virtuous wage spiral, price spiral at the moment, is going to continue. But of course, I have to say that beyond a certain point, it could turn into a vicious cycle between wages and prices. Yeah. We, of course, worry about this a little bit, but at this point, I must say it's a remote possibility.
Thank you. The announcement that you and your fellow members of the committee or the policy board made in March was quite momentous in title and in impression. And you were speaking about essentially a change in framework in your remarks just a moment ago. But the actual changes in interest rates, either by the BOJ's policy rate or your target, your removal of target on the YCC, or in markets have not been very large. Is this desirable that you want to see very small movements? Is this, the long-standing debate over interest rate smoothing, is there a place you want to get to that you should be getting to faster? I mean, how do you think about the large versus small movements question?
Okay. I would say the reason why the response of interest rates to our policy change or change in the policy framework, the reason why it was small is essentially twofold. One is that we said in our statement that, I said it as well in the speech, that we expect accommodative financial conditions to prevail for the time being. And then secondly, I think our decision to hold the amount of JGB purchases at the same amount as before for the time being has often affected the response of interest rate movements. But with the policy change, I think we have brought more flexibility in terms of what we will be doing with our policy. So depending on incoming data and information, we may change the short-term policy rate. And as I said, irrespective of what the data will say in the near future, we would like to find a way to, or find a timing to reduce the amount of JGB purchases.
Speaking of JG purchases, you were very clear now and in your opening remarks that the flexibility is there. The Bank of Japan can intervene should there be a rapid or large movement in the 10-year JGB interest rate. Is this something both for the BOJ and in general for large economies with large public debts in their own currency, like the US? Is this something generally that should be in the central bank's toolkit? Is this a thing you want to have indefinitely for the Bank of Japan, or is this an emergency measure?
So in principle, I don't think so. I mean, long-term interest rate, determination of long-term interest rate should be left to the market. But coming out of the long period of large intervention by us in the JGB market, we thought it was dangerous for us to remove the intervention completely in an abrupt manner. So we would like to do so in a gradual way. As I said in the speech, we would like to take time to consider and determine at what timing and at what speed we would be reducing the amount of JGB purchases.
It's a big responsibility. Monetary policy and the exceptional measures or the quantitative easing regime have attracted a lot of attention and commentary in Japan and beyond. And one thing that I know you've heard and talked about is the idea that ending zero interest rates would help get rid of zombie companies in Japan. I mean, this was not something the BOJ ever advocated, but that a lot of influential business people, thinkers, politicians in Japan used to talk about this. So how is this going? I mean, do you feel like the change in the monetary framework is having an effect, a sort of creative destruction effect on zombie companies, or is this something that's just not on your radar, not anything to think about?
Let's see. I think it's basically, I think it's a bad idea to say raise interest rates in order to get rid of zombie companies. Now, alternatively, it would be healthy for interest rates to go up because of rising inflation. And you would say that rising interest rates as a result of rising inflation is not going to create, in general, not going to create trouble for the borrowers because their sales are going to rise with inflation. But then there are some companies who can't keep up with inflation or whose sales don't rise by as much as inflation. Then they will have hard time meeting interest expenses or higher interest expenses. And as a result, they could go out of the market, which I think is a healthy process. I don't think this is occurring at the moment in Japan, but could be, we may see some of this taking place in the near future.
Thank you. Again, talking about some issues in the domestic financial economy. One thing that seems to have been marked in recent years is a rotation of Japanese savings from fixed income to equities and various other risk assets, even a little real estate. Now, the Abe and Suga and Kishida administrations would no doubt take some credit saying that's because of their corporate governance reforms, among other things. Not asking you to comment on that necessarily, but from the BOJ's point of view, how does that affect your forecast and your thinking about the transmission of monetary policy and assessing the stance of policy if there are these movements, these sustained movements in sort of asset allocation?
So I'm sorry, I can say only abstract things.
Yes, that's fine.
Holding the short-term policy rate constant, what you said would mean easier financial conditions,
Right.
which should be taken into account in setting future policy interest rate level in response to incoming data and information.
Abstract and brief. Let me, I'm not trying to get you to say something inappropriate, but let me, if I could, just follow up on that question. One thing that's been striking in our discussions of major central banks policy, BOJ, ECB, Fed, others who may be possibly major central banks, is that we don't seem to have a great sense of the monetary transmission mechanism. And I know this is an issue you've thought about in your previous role at the bank and in your research. I mean, given the way things have gone over the last couple of years, and given the way that, as you mentioned, a lot of ease and a lot of unconventional policy in Japan did not seem to transmit into higher inflation. I mean, just, again, abstract, general, if you like, but how do you see the issue of monetary transmission?
So let me answer this way. If underlying inflation continues to go up, we would be very likely raising interest rates.
Right.
Then what we will have to determine, of course, by how much we would raise interest rates in response to changing inflation outlook. Yeah. In doing so, we would need to make sure that we have a rough idea about how the economy and inflation is going to respond to a rise in interest rates. Now, we don't have a period of rising interest rates over a sustained period as far as the last 3 decades go. So it's very hard to estimate this elasticity using past data. I think this is going to be a challenge for us.
Yeah. For everybody, I think. Taking you, I know you don't want to comment on other central banks' policies, but just more broadly thinking about putting Japan in context. There's been a lot of discussion in the financial press and in Washington this week about the idea that the US, Euro area, Japan, UK, others went through what was in your slide 1, this similar huge burst of transmitted inflation shock that then came down relatively simultaneously across countries. Obviously, energy and food, very important imports for Japan. How do you compare the post-COVID recovery of Japan compared to the US or Europe? I mean, in terms of surging ahead, some people would have the US doing. How do you think Japan has done, and more importantly, why?
So, as I said, with regard to figure 1, the inflation dynamic has looked fairly similar across many countries. But one possible difference between us and US or Europe has been that the response of inflation, our inflation, has been much smaller than in US or Europe. And I guess the reason is perhaps the one I discussed in the remarks, which is the entrenched nature of zero inflation expectations and its effect on the pricing behavior of companies.
Sorry, just one follow-up on that. So when we think about globally traded goods that Japan imports, like fossil fuel energy or various kinds of food, often which you're paying for are priced, some of which are priced in dollars,
yeah.
And obviously the yen has depreciated some. So again, you may end up just restating the same thing, I understand, but it is striking. It just seems like how little inflation you got given what you're importing and given the weakness of the yen. So, I mean, so when you say the price expectations were so low, so is that nobody passed through the energy costs, or the energy costs didn't pass through to other parts of the economy?
So initially, honestly speaking, we underestimated inflation.
Huh.
Or underestimated the degree to which such pass-through was going to take place.
Right.
Over time, we revised upward our inflation forecasts a number of times, actually.
Yeah.
The reason why this had happened, I think, was inflation expectations, as I showed in one of the charts, slowly responded to the rise in actual inflation, which over time increased the degree of pass-through. Mm-hmm. So the period of high inflation due to the first component of the two components I described in the first chart extended over a longer period of time than we thought it would. And also it spilled over to wages, specifically to wage formation in the spring wage negotiation of last year, and then to prices. Therefore, the first round effects generated some positive upward movement in the second component of the inflation dynamic as well.
Thank you. Very clear. What, in your mind, are the challenges for the Bank of Japan to pursue, let's call it a tightening bias, in a world where many central banks, major central banks, are either cutting rates, announcing future cuts, or perhaps in the case of the Fed, remaining on hold? I mean, does that make life harder for you in some way?
So again, I have to respond in a very abstract way. I don't know when the ECB or the Fed will lower interest rates, but if they do, this will surely impact asset markets, including the exchange rate. Also, if it is going to be hopefully some type of soft landing, the path of real GDP growth will be better or healthier than otherwise.
Yeah.
All these things will affect our inflation and economic outlook, and in response to changes in this outlook, we will respond hopefully appropriately.
Okay. That was the only one that was a little too abstract, but okay. Just joking. During your remarks, you made mention of the concept of R star, of the neutral rate. And you mentioned the fact that estimates, of course, vary widely, yes, be it for Japan or anywhere. Notwithstanding, it seems to be a useful framing device for discussions. There's a lot of talk in the US context about R star rising or having risen, depending who you ask, post-COVID. So first, do you think R star has come up significantly in Japan in recent years? And second, again, this can be very abstract, but I mean, as a monetary economist, central banker, do you think there can be meaningfully different sort of R stars for Japan and the US for a persistent period, or do they have to equilibrate at some level?
So these are too hard a question for me to answer, but let me just, I have seen our staff's estimate of our star, and there's 5 or 6 estimates around. They, as I said, vary widely, like in terms of real interest rate, 0% plus minus 1%. Wow. It's all over the place. Right. As Jay Powell said, we are guided by our star, but under cloudy sky. Mm-hmm. Anyway, turning to the second half of your question about whether two countries can have different R stars over time. I, again, don't know the right answer, but at least in the short run, it's possible, I think. I would say with some confidence that R star in Japan at the moment is lower than that in the United States. This could create some adjustment, very likely in the form of capital outflow from Japan to the United States, or something like this has been happening for 3 decades between Japan and the rest of Asia. Yeah. But it takes a while for the natural rates in the two countries to converge to the same level.
Thank you. We're coming up on time. The governor's been very generous and very open. One last question. You, as mentioned and as everyone knows, you have a distinguished career as an academic monetary economist as well as a central banker. With your speech, more importantly, as important as the speech was, with the March meeting, you announced the start of a new framework in Japan for monetary policy. So looking back on the, let's call it 20 years of the exceptional framework, do you have any general lessons about monetary policy or about macroeconomics you think we should take away from that?
I would point out 2 things. The first is what I said in the remarks, which is if you experience a fairly long period of deflation or near zero inflation,
right.
Let's say zero inflation expectations can become entrenched, and it becomes hard for the economy to get out of that equilibrium. So the lesson is it's best to avoid getting into or falling into that position. The second, I would say, is the so-called zero lower bound on interest rates, or effective zero lower bound on interest rates, is real. Even though we have various measures like quantitative easing, large-scale asset purchases, or even YCC, it's not a perfect substitute for a large cut in short-term interest rates. So you have to be careful about the constraints created by the zero lower bound on interest rates.
Terrific. Thank you for sharing your wisdom with us. Thank you for your service in the international community and at the Bank of Japan. And thank you for today explaining additional insights into the new framework, the return to more normal monetary policy in the Bank of Japan. Ladies and gentlemen, please join me in thanking Governor Kazuo.